this tutorial, what we're going to do is teach you how to use futures on a centralized exchange. This is significantly more complicated than spot trading and is not for beginners. If you try and attempt to margin trade as a beginner, the probability of you losing all of your money is extremely high. So don't do this. Only do this if you really feel confident and you absolutely need to. Otherwise, stay the fuck away from this. But without further ado, let's get into it. First steps first. Do not ever use coin margining for your futures trades. With your balances, you want to have only stable coins in here, which your margin is being opened against. If you have tokens in here, like Bitcoin, Ethereum, or some other trashy bullshit, and the market starts to decline, your margin is going to be declining in value at the same rate at which your position is declining in value, which means that your liquidation levels are going to come up exponentially faster than you expect, which is certain death. Do not do this. Only ever have stable coins or cash, something that's a cash equivalent in your balances that you're borrowing against when you're opening margin positions. Stick to this rule all the times at a very minimum. What we're going to be doing is we're going to be opening a hypothetical long position on Bitcoin. We have our cash margin, essentially, stable coins or cash, whatever it is, and we're going to have a margin here. We have buy and sell options. This is equivalent of going long and short. I don't know why it doesn't say long and short. I guess it's for simplicity purposes, and we can have a whole bunch of different orders. Now we're going to have to become familiar with these different orders. We'll do that as we do it. So let's say we want to bet on the market rising. We can move the slider up, and as you notice, wow, look at the leverage that we can take on. We can take on a whole shitload of leverage, way more than what we actually have. See, the portfolio value is $600. That's all the margin that I have in form of stablecoins. Yet when I move this slider up, I can open a position equivalent of 2,600 or more, right? But of course this increases the projected leverage and raises the estimated liquidation level closer and closer and closer to the current price. The further out to the right I move this fucking slider, the further up my liquidation level becomes, which means the less volatility is required to completely destroy me. This is the reason why, if you were to ever use futures, which you probably shouldn't, but if you do, you should never use more than just a tiny bit of leverage, if that. Don't advocate for leverage, but of course I know that people are going to do it anyway, so it's like teaching people how to use drugs safely. Obviously don't overdose. Let's say we wanted to go 2x, so we're going to open a $1,200 long position on BTC using a market order. Let's do that now. You can see here the projected leverage is 2x, and it tells us how much margin is being required from us, from our balances, and the available margin to us. Everything looks good to go. We have an estimated fee, margin by market, 1,200, 2x leverage. Everything's perfect, fantastic. Buy. Okay, now you see it's opened a long position. Now the terminology here is correct. The position's open, fantastic. So if it goes up, we make money. If it goes down, we lose money. However, a lot of people will want to use different bracketed order types in order to control this, just in case there is some liquidation levels. Let's say we thought the market was going to go up to $32,000. So we want to place a take profit at $32,000. We've opened up a buy position. So in order to close a position that we've bought, we must sell either above or below. That's the opposite of what we just did in order to reverse the transaction. That's the reason why this wasn't working before, because I can't take profit as a buy. If the price goes up, I've already bought and I want to sell higher. It's a sell, take profit position. I put in the price level that I'm targeting, which is $32,000. And how much of the position am I going to close when it reaches that? All of it. So I place that position, and you'll notice it doesn't execute immediately. The long position is still open. It's just placed a sell, take profit order at that price. If my long position goes up, it will sell at that price. But of course, if it goes down, it's going to go down to infinity still. So I want to place a stop loss level there. Select the stop loss. What if we think it's a reasonable stop loss level is 28,000? We're going to place 28,000 in the trigger price. And how much of that do we want to close in the position? All of it. Obviously, completely close it 100%. Reduce only, yes. Always turned on, so we select sell. Now you'll see that we have two conditional orders on our book now. We have a take profit order and a stop loss order. they're both set up ready to go. So in case the price goes in either direction, we have something that can protect us from complete liquidation, whatever it is. So if the distance is 6.9% or 6% away from both of these and we're 2x leverage, we'll lose probably 12% of our account, probably 13%. If it goes up or down, that's just the risk you take using leverage, whatever it is. But this isn't a discussion on how to use futures for profit. This is simply an explanatory lesson on what the fuck they do and how to use them. Now, what do we do if we want to close our positions or cancel these orders? You can see that we have a couple of different options available to us. We have the little X next to these things. We have cancel order. Strangely enough, we don't have an X next to the long position, but whatever. We can either cancel the orders from the book down here, or we can just click them straight on the chart like this. Are you sure you want to cancel the take profit order? Yes. Boom. Are you sure you want to cancel the stop loss order? Yes. Fuck you. Now, with positions, we have the option of simply pressing this close button here, and we can perform a market close on this position. That's an easy way of doing it if you want to close them immediately without any remorse or anything like that. Alternatively, what you can do is you can reverse the transaction by selling at market 100% of the volume of the current open position. You can see that we have it set to reduce only. This means that it will not open an opposing position, and I can slide this motherfucker all the way to the right hand side and that it's not going to accidentally open a short position and fuck me over in both directions. So I'm going to sell my position, and magically it closes everything. So I've shown you not only how to open a position, how to manage that position, and how to judge all of the different numbers and bits of information that you have coming at you. I've also shown you how to place take profit and stop loss levels and orders, volume adjusted. I've shown you how you can easily close them, whether they're conditional orders or positions, and I've also shown you the hard way of closing those orders as well. So you'll find that these same principles are the same across every single exchange. It's not going to be any different on every exchange. It's going to be the same thing. They're going to use the same terminology. The same principles apply. Don't come asking me, hey Adam, is it the same on this exchange? Or is it the same on this exchange? It's all the same, right? Understand the principles. Don't be looking for an exchange that looks exactly like this just because I made a video for this particular exchange. Maybe Kraken blows up in the future. Okay, maybe we need to use a different exchange. I don't know.